And we're on.
All right. You hit record, right?
It's going to happen one day.
As it is, right? I was
it is recording. You got one job, Conan.
I know, you got a lot of jobs.
Record.
I got one job. You got a lot of jobs.
Record the damn show. Yeah. All right. Hope everybody's having a good week. We are trying to have a good week. Work's been getting in the way.
Work has been getting in the way. And it continues to get in the way.
We've had a lot of excitement this week as far as Grow My TSP.
We have indeed. Let's get to that in a second, though, just so I don't get too off track on this whole thing. For whatever reason, I wanted to do the quote first. Weekly update, 20 September 2020. This quote is from Larry Williams, master trader, focuses mainly on futures market. He's a best-selling author, sells trading courses online. Has twice won the Republican nomination for Senate in Montana. So this is what he has to tell us. The most common bad habit I have seen in traders, good and bad ones, is the inability to react correctly to market action. So
what's that mean?
Here's the deal with that. Virtually everybody wants to anticipate what the market's going to do.
Of course.
Right? Everybody wants a crystal ball. The guys that are really good, and have in their mind statements like this: the inability to react, and I actually like respond correctly to market action. Mm-hmm. You're reacting or responding
to the market. You're not guessing what it's going to do.
You can have an opinion. You can line up all the dots and say, okay, if this happens, then we're going to do these things. That's analysis, right?
Right.
When it does A, B, or C, whichever of those things it does, then you respond or react to it. If you set it up in a different way, like this is my analysis, therefore I think the market's going to do X, your ego gets in there, mm-hmm. right? So if you can keep your ego out of there by responding or reacting to what the market action does, you are way better off. Because then you can draw your basically lines that'll show you how much risk you're actually taking. We're going to get into that a little bit, but if I know the only possibilities are A, B, and C, then if A happens, I know what I'm going to do. If B happens, I know what I'm going to do. C happens, I know what I'm going to do. And I know what the market risk is in each of those cases. So you're good. If you do it the other way, which, I think Trump's going to win, so the market's going to take off. Well, great. You set yourself up for failure if Biden wins, right?
Right.
That's all I'm saying.
Yeah, you can't paint yourself in a corner. You can't guess. You just got to react to the market as it happens, right?
That's the best way to do it.
And here you can write this quote down: "Ego is a no-go."
Ego is the enemy. I like that. Ego is a no-go.
All right.
So, first things first. Welcome to a whole bunch of new members. As I'm sure you guys, if you haven't seen it already, you will by the end of the weekend. We launched a new site, and Conan's been doing a truckload of work here. We got a bunch of new members to the site.
But ton of work.
And to the Facebook group and the page and all that, and hopefully on Twitter also. So Conan's going to walk us through the highlights.
Yeah. So basically, when we started this thing, it's been several years ago. You started it long before, right? And we came together and kind of decided to take it from the newsletter days to online kind of newsletter. And for those of you that don't know kind of the legal parts of all of this, basically there's the thing called a newsletter exemption, right? And that's really where folks like us fall, where we're not touching your money. Right. We're helping you figure out where to put your money in, coaching, financial thing. Right. It's different, right, than a financial, direct financial advisor. Right. So the point is we kind of moved it online, but when we did, like many kind of small businesses, we started on a shoestring and we started kind of small. We weren't sure what would work. And honestly, technology hadn't quite caught up to what we needed. So the bottom line is it has. And we've decided to kind of turn the volume up a little bit. We started this show. We've done a few other things. We're going to start adding some other things to the site. So it was time to kind of step it up a notch as far as our back end, our platform, not to get too geeky, but we needed something more robust, better customer service tools, all those things. So that's what we did.
Texting was the big one. I think people probably
that was
saw
the first
website.
move, and now that's integrated. Everything we had was like band-aided on, right? It was some other vendor, some other thing. Now it's all inclusive in one tool for us anyway, and it'll hopefully that will show for the customers.
Yeah.
And as part of that rollout, if you guys haven't seen, I wouldn't call them ads, but we put up a few things on Facebook to tell people. We sent out on our email list that now is the time to join if you're on the fence, because we have increased the rate for new members on the new site. The new site is growmytsp.com.
Yep. Much easier than grow my thrift savings plan.
Yeah, spelling it out. Yeah. Now they both will go to the same site eventually after we get done with the migration. All the current members are being migrated over right now. It takes a little time. We have another vendor helping us do that because it's safer. But anyway, the point is now's the time to join, because we're letting people join the new site at the old rate while we're doing this migration, and we're hoping that people see the value in that. The increase isn't that much, but it's enough if you stay a member for years, which we've had plenty of people do. Yep. This will save you a lot of money. And here's the bottom line, and you say it quite often. It's like one move, one good move, one alert from our site. Yep. And there's times when people have saved 30% of their retirement or more, right?
Sure.
I mean, at
February.
least. Yeah, it just happened, and it's happened before. It's not uncommon for a few moves a year to make you thousands of dollars, or save you thousands of dollars. And if that's not worth $12 a month, I don't know what it is. Right. So we keep the price low to keep the barrier down. Right. We want to help as many people as possible. There's a lot of people out there that charge thousands of dollars a month. We know them, and some of them we pay to do it. Yeah, right, because we watch them. But now's the time, if you're not a member already, to join and share it with your friends, because you're going to lock that rate in for life. We never raise it on current members, and anyway, we think there's a huge value, and we're going to be adding a lot more to the site. Now, what do you got for us, Jerry?
All right. So for all you guys out there that are new, I'm going to kind of give you three things to think about. Well, first of all, I would say definitely go back and look at some of the weekly updates that we've been doing here, and maybe go through some of the weekly update shows. But three sort of topics to kind of think about. So what we do here is manage downside risk, right, while maximizing gains for long-term TSP growth. Okay. Rule number one is don't lose money. Okay. Rule number two is you have to be in the stock funds when the market's going up to grow your TSP. So it's a long-term game. It's a marathon. It's not a sprint.
Okay? And it's definitely not a set and forget.
Right.
We get that so much from people that that's what works, and we don't have to go down that rabbit hole right now. But this is I don't know if this is the opposite of it, but it is definitely different.
Yeah,
in that philosophy.
Yeah. I mean, there are a lot of ways to play the game, and our way is kind of unique. But pretty much everybody, what they try to do is it's a long term for everybody. TSP is a long term. It's a retirement vehicle, right? It's not day trading. So the set it and forget it idea, I guess, probably exemplifies that the most, because you're not really doing anything. You're setting it and forgetting it, right? But what we're doing is trying to manage the risk, which implies some active movement. So two rules, right? Don't lose money, rule number one. And right behind that, rule number two is you have to be in the stock funds for your TSP account to make decent gains. Okay, so our philosophy about that is definitely unconventional, right? We focus on market risk as opposed to individual or personal risk. So if any of you guys have been to a financial planner, you sit down with them, they ask you what your goals are and how much you make, and they extrapolate out forward to the year that you are planning to retire, and then they give you a dollar value in that year's, taking into account inflation to that point. Then they look backwards and say, okay, if you want these things on that date that cost that much, you need to contribute X amount into your retirement every month or whatever, at an assumed 6% rate of return, and you'll have the goals that you want at the end of the day. That's great. It's focuses risk on you as an individual. What we do here is,
because the market doesn't care about your risk.
Market doesn't
personal risk, right? So the market's going to do what the market's going to do.
Right, and it goes back to the quote, right, from Larry Williams. the best way to be on the right side of the market is to respond to what the market does. It has nothing to do with your age, your goals, nothing.
Yeah.
So
where you're at in your career.
Right. I mean, we talk about it a lot, and so if you're new to the site, you might be kind of amazed and confused to hear this because it's very unconventional.
I know it is very confusing for a lot of people that get into the Facebook group or join the site because it's just so different than what you've been hearing for so long.
Right. I won't say nobody talks about this, but nobody talks about it to retail financial people. I mean, all we get sold as retail, people that have a life and have a little money to throw in a retirement plan is, give your money to a financial planner and they'll manage it for you, and they're doing it based on you fall into, one of three risk buckets basically. And this is also how the L funds are created, right? The idea is you're decreasing your exposure to stocks as you age and or get later in your career, so that you're reducing risk, because the idea is that being in the stocks are inherently risky. Mm. It's not that being in the stock funds are inherently risky.
It's risky to be in there when it's going down.
Yes, right. Or when it's looking to be at the top or going down. Yeah, that's when it's risky. And at the same time, to be in the G fund or the F fund for that matter, but to be in the G fund when the market's going up, there's no risk, right? Because the G fund can't go negative by law, but the opportunity cost is your risk.
Right.
You're not growing your TSP account when you're in the G fund. So if the market's going up, it doesn't matter if you are just starting your career, or if you're in retirement. I mean, you would manage. I expect to manage my TSP exactly how I do now when I'm in retirement.
Yeah,
and it's the same way I did it.
If anything, sometimes you can be a little more aggressive because you can focus on it more.
Yeah. Well.
Right.
Yeah. Definitely. The only downside is that you're not making contributions anymore.
Yeah.
But other than that, the added benefit to being retired. If you do a rollover, is you don't have the TSP restrictions. So,
yep.
But that's a different show. Anyway, lots of ways to play the game, and the way we do it here is primarily with technical analysis, which is charting of the price over time, right? And that is what keeps us on the right side of the trend. So.
Yeah, and so the opposite of that, or not, I hate to say opposite, but a different version of that is fundamental analysis, which is a lot more voodoo.
It's funny because those guys would call our stuff voodoo.
I know. Yeah. But this is data driven. It's why I believed in it when I first started following you, is because I believe in data. I believe in true information, not, kind of gut and guessing, right? That's not, especially with my money.
It's interesting because it would be really interesting to have a fundamental guy, which there are guys out there, and we should have them on the show sometime, because the fundamental guys absolutely have data. Yeah. It's just that I would argue, if you're a technical analyst guy, the argument is that the data that you that supports your trading methodology, if you're a fundamental guy, that data, like causation isn't. Correlation isn't causation, right? So just because the earnings go up, because everybody hangs their hat on, earnings.
It's more driven by what the companies are doing versus what the market is doing.
Yeah, there's all kinds of data that they point to. At the end of the day, the technical analyst says, okay, all that data, everything that you can talk about as a fundamental guy, all that data is reflected in the price when the transaction happens between the two parties. So the only thing that really matters at the end of the day is how much I'm willing to sell you this share of stock for, right? Mm-hmm. It's the same thing if you're buying a house. I mean, people can say, well, my house is worth $1 million and my house is worth this and that. It's only worth whatever somebody else is willing to pay for it. That's what it's worth.
Right.
Take everything else into consideration, the neighborhood, the it's a different mayor than what I want, the color of the house, all that stuff. And you can say, well, because, the house next door just sold for whatever, therefore my house is, we have the whole comp industry, right? The only thing that matters is when it comes right down to it, I'm selling you my house for X amount of money. That's it. That's what it is. So same idea with this. So, all right, those were three concepts essentially. Something to think about that's kind of different for what we're doing than what you might see in other, other places like this. If you could find another place like this. Okay. Let's see. So,
what is the market doing this week?
what is the market doing this week? Honestly, I went back and started adjusting the slide, and I didn't have to do very much.
From the last week.
From the last week,
Yeah.
really.
We got to find another word than volatile, just so we can mix it up a bit.
I know.
But
I
it
know.
is volatile.
It is. It's because what happened this week? All it did was went up and then came back down. I mean, we'll see it on the chart, but all it did was last week it was on the 50-day moving average, went up, came back down, and closed this week just below it. But that's where we are. So another volatile week. Tech continued to struggle, and all three of the stock funds are still trying to grab a hold of their 50-day moving average. If the 10-day moving average line crosses the 50-day moving average line on the downside, it's a pretty big red flag. They call it the death cross when the 50-day moving average crosses the 200-day moving average. So what that is a bigger perspective.
Right. You've pulled back farther.
You pull back further. So that's for the 10-day to cross the 50, it's just closed in, right? But you'll see it. You'll see it. It's on all the charts. So first thing we're going to do is take a look at the Fear and Greed Index, which, what was I here? Yeah. We're going to start with the Fear and Greed Index. Members of the site will recall the Fear and Greed Index was one of the key indicators that we used to do the August 30th alert for reallocation. And that got us to avoid the first part of this little correction that we're in right now. Fear and Greed Index has moved off its high over the past 2 weeks, but it's still nowhere near the extreme fear range. So we'll talk about that. Then the put-call ratio chart, a put, okay, just real quickly, a put is a bet that the market's going to go down. A call is a bet that the market's going to go up. So the put-call ratio, if the numerator is higher than the denominator, it means there are more people buying puts than calls, right? So more people are betting that the market's going to go down than the market's going to go up. The more people that bet that the market is going to go down tends to indicate that the market is at a bottom. It's a contrarian indicator. Okay, I know this sounds goofy. You'd have to kind of think through it, but the higher the number of the put-call ratio, the more likely you're close to a market bottom. Okay? Well, we're going to talk about it some more, but that's the idea. And then we're going to get into the daily charts. Okay. I need a coffee.
Got to take a drink of coffee every once in a while.
What is this called again?
Coffee.
Oh, no. Cold brew?
Oh, from upstairs. Yeah, we have this fancy cold brew, what do you call it? Like a
tap.
Yeah, tap. We don't have it. The building that we're in has fancy little amenities, and it's one of the reasons why we moved in here, because it's cool.
Awesome.
Yeah, got my little latte from the thing down there. Anyway, self-serve.
Yeah, good.
We don't have any baristas.
Cool place. Okay. Fear and Greed Index. So, 2 weeks ago, the reading on this particular chart was, let's get my pen out here, was 79. So we were in extreme greed. We were somewhere around here 2 weeks ago. And pretty much everything, all the different pieces that go into this Fear and Greed Index were at extreme greed 2 weeks ago. And that, again, is part of what got us to do that alert on the 31st of August. Since then, the market has come off a bit, and now the overall number is neutral. So what does that mean? The market has come down some, but it hasn't come down enough to generate fear as an emotion, an overriding emotion in the marketplace. So what does that mean? It means we haven't hit a low yet.
Mm.
Okay? It doesn't mean that it can't go back up towards greed, but if we're in a correction that's going to go lower, we're not at the bottom yet. All right. That's one thing to think Um, so this is Fear and Greed. This particular one, it's one snapshot. Okay, and we're going to talk about a bunch of different snapshots, but this is one. You have to put it in context with the price chart, moving average lines, support and resistance levels, and we are going to do that on the next slide. So what does Fear and Greed look like over time? 79 right there is where we got out when the Fear and Greed index hit 79 at the end of August. That's when we reallocated. We took some money off the table. So if we get a more severe correction, the Fear and Greed index comes down here, and say we get something like this. Now we're in extreme fear kind of range. That's generally when the market's at a bottom. It's one of the indicators that the market's at a bottom. So what it's telling me is we're not there yet. It's possible that okay, the market we do something like that.
Mm-hmm.
But every time, if you go back and look at this, whenever it does top out, it tends to come down pretty hard, right?
Yeah.
It's possible that it can turn back around and go higher from here.
But I mean, you can easily see. This is why I like charts, right?
Yep.
So you can easily see as it starts to bump off that 80. Generally speaking,
right,
it's coming down, right?
Yeah, and it's broken this trend line here. It doesn't look good. It doesn't look good. We were fortunate enough. We took about half of our account off the table here at the end of August. So we've only been exposed to half the losses, and now we're going to figure out whether or not to take more money off the table, or maybe it's time to kick more money in. So if you want to know what we're doing with our individual TSP accounts,
join the site.
Join the site. Okay. So that was Fear and Greed. Another, the other one that we talked about was put-call ratio. So like I said, a put is a bet that the market's going to go lower. A call is a bet that the market's going to go higher. So this is a 1-year daily chart of the put-call index. And so you remember back here in March, what happened was the market spiked, and the put-call ratio, meaning people that were betting the market was going to go down because there's a lot of fear in the marketplace. When it spikes, that tends to be the bottom. Okay, so most of the time, the put-call ratio kind of churns. Right, that's the vast majority of the time it churns. When it gets above 1, right, 1.0 is an even number of people are betting against the market that are betting for and betting that it's going to go down versus betting that's going to go up. Once it gets above 1.0, more people are betting that the market is going to go down. That's an indication of a lot of fear in the marketplace, and that's when you start looking for a bottom. Okay. We are not there yet. We're close to that 1.0 level, but that's sort of the beginning of when you start to think about we might be getting to a bottom. Okay. We're not there yet. Williams percent R is another good technical indicator. We just got to overbought levels in the Williams. We're not there yet. So that's sort of snapshot number 2, right? Mm-hmm. Snapshot number 1 was fear and greed. Snapshot number 2 is put call ratio. We're not there yet. Okay. So if we go to the daily charts, this is the C Fund 9-month daily. Let's see. Let's just zoom it in first, and then we can go back. Okay. So not a great pattern, but it's not collapsing, right? We're not seeing what happened back in February, right? It's not collapsing like that. We had a couple of down days there at the beginning of September, and it's been consolidating sideways ever since. We talk about how important the 50-day or the 10-day moving average and the 50-day moving average. The 10-day is the red line. The 10-day is the blue line. The 50-day is the red line. Okay. It's not a great looking chart, but on the positive side, on Friday, you can see the red candlestick. We didn't close at the bottom of the day's trading range, right? So by the end of the day, the market had hit a low of 32.92 on the day, but then closed at 33.19, right? It closed below the 50-day moving average, but not by a lot, right? So here's the thing. I almost kept the same quote from last week, which was "do note," because it's still non-committal, right? It's just non-committal. Based on this chart.
There's not enough information to go either way yet.
Right.
You got to still watch.
Right. Based on this chart. Like we said before, if the 10-day moving average crosses the 50-day moving average on the downside, it's a big red flag. Basically because if we look at this, so this is what happened back in February. Once the 10-day moving average crossed the 50-day on the downside, every time the market tried to rally and go higher, it found resistance at that blue line, at the 10-day moving average line, right? And it kept going down. It rode that 10-day moving average line down until finally, March 23rd was the low, and then it kicked higher. But this is the value of the moving average lines. It's not exact, but they definitely provide support and resistance, right? So what we have right now is either we're going to get support there at that 50-day moving average, or the 10-day moving average comes down, crosses through it, and it'll be resistance. We just don't know yet. All right, last thing on this chart, because we always talk about volume. We had a huge spike in volume on Friday, right? There's a thing called a triple witching day. I think we talked about this before, but triple witching day, okay? It's on the third Friday of the last month of each quarter. All right, so every quarter you're gonna get this. It's the expiration of stock index futures, stock index options, and regular stock options. So the futures market is based on time, and so when those options expire, everybody's trying to sell them. If you're still holding them, you want to sell them at the last minute. The idea is not to hold options into expiration. So that expiration date tends to generate a whole lot of volatility and a lot of volume, and that's why you get that spike. So for our purposes, we can disregard the spike on triple witching days. So any other day, it's important. If we had a spike like that on a day where it wasn't a triple witching day and the market closed below the 50-day moving average, I'd be selling. Mm-hmm. I'd be selling absolutely. And if we did get a day with that much selling on a non-triple witching day, it wouldn't have reversed. It would have closed at the bottom of the day's trading range. There would have been other indicators, other reasons to sell. But this is kind of part of the nuance of this stuff, which is why I don't think you can create an algorithm that will tell you all these things. I mean, there's so many inputs, and you have to look at it. It's like riding a bike. Like, you have to get the hang of it, and then once you get the hang of it, you can do it, right? You see it. Anyway, that's the C fund. Okay, S fund. Looks similar to the C fund, except we got this support line, right? You got the support line right here. So that began back here at the sort of the initial high for the, following the crash back in February. So the initial high off of that happened at the beginning of June. And since then, the market's basically been going sideways. But you got this support line. So we topped out here at the beginning of June. We hit that level again and couldn't get above it. We churned, right, for several weeks there in July. Then we popped up above it in early August, which was great because it got us out of that trading range. And now this line should be, instead of resistance, right, because it hit here, now it was resistance here, couldn't get above it. Resistance here, couldn't get above it. Then, okay, it popped above it right there. All right. Now it stayed above it. So now that line acts as support, right? And it's still acting as support, along with the 50-day and the 10-day moving averages, right? Actually, this is the I fund. Okay. Somehow we flipped a chart too far, but it's the same thing. So it's providing a lot of support there. We got a little bit of a spike on the down day for the same reason. It's triple witching day, so don't worry about it. But the I fund, the chart actually looks pretty good. I mean, I wouldn't sell this at this point, Okay, there's the S fund. S fund, basically the same thing, right? You got the top there in June. You get churning right here. You couldn't get through it until that gap up right there was the definitive thing that said, okay, this resistance that we're hitting here is now should be support, which it is. You can see it right there. It's being supported there. So again, yes, the 50-day moving average, the 10-day moving average, I mean, it looks like the 10-day is getting ready to cross the 50-day. It's not a good sign. But we got support here, and I would let it come down possibly to here, expecting some support there. If you're, again, your personal risk tolerance and all that. So kind of to sum it up, you got the snapshots of the fear and greed index and the put call ratio don't look good. You got the charts that, based on the moving average lines, don't look good. But there's definitely some support levels that are still holding. So if you are risk averse, you could take some money out of the market here. I mean, it's absolutely possible that the market gaps down in a big way on Monday. Absolutely possible. Yeah. It's also possible that these support levels hold. We just don't know. We will know. I mean, this is going to go one way or the other, and we'll know when it does. We'll know it.
Yeah.
And again, that's how I like to play this game: is to respond to what the market does, not try to anticipate what it's going to do.
Right.
And so I lined up all these, dots or whatever, all these indicators, and I'm ready to move one way or the other, but the market hasn't told me what to do yet. So that's where I am.
That's where we are.
That's where we are. However, if you are a member of the site, do not be surprised to see an email soon this weekend. And actually, let me just talk about that for a second. The 31st of August, we put out an alert when we talked about how one of the reasons was because of the fear and greed index. Another big reason is because it was the end of the month. So you get 2 moves in TSP. You get 2 free moves a month. Any move you want to do after that can only increase your holdings in the G fund, right? So since we did our last move in the 31st of August, we still have 2 moves to do in September. Okay, it's Sunday is going to be 21st. So Monday's going to be the 21st of September. There's 10 trading days left, less than that, 8 trading days left in the month, and we still have our 2 moves to use. So it's tactical. Like you gotta look at all the market and the support and lines and resistance lines and indicators and all the rest of it, and then you have to look at the day of the month because you only get 2 moves a month, right? So if you're a member of the site, you haven't used any moves in September yet. It puts us in a position to do things that you wouldn't be able to do if you had used moves in September.
Right.
So that's all I'm going to say about that.
Let's touch on real quick. Is that pretty much what you got for us?
That's it.
Let's touch real quick on a question we get a lot since we are getting a lot of new members.
Yep.
Just give us a 30-second version, minute version of the question. I'm a new member. My allocations do not match yours on the site right now. What should I do?
Yeah.
It depends.
It depends. Yeah, it depends. And we got that question a lot in March when the market really started going sideways. We got a lot of interest in the site, as you could imagine, and people were asking, especially towards the end of March. You were down 30+% in your retirement account, your TSP account, and they signed up as members of our site, and then they looked at it and said, okay, well, I've lost if I reallocate to where you guys are, I will have taken all these losses on. A, the losses are on paper, but B, yeah, if you are in the stock funds and you've taken those paper losses and then you move into the G fund, yes, you have locked in those losses, no question. You don't know how much more the market's going to go down is the problem, right? At some point, you got to bite the bullet and get on board, right? That's really the answer to the question. At some point, if you're going to follow our allocation, and again, this is an educational site. The idea isn't that you just blindly follow what we're doing. The idea is that you sort of validate your decisions.
Yep.
You're watching the show, you're reading the stuff that we put out.
And that is key, right? So the key is why you chose not to follow that allocation.
Right.
Right? That's the difference. Right. That you didn't just say, I don't know, you made a decision based on your risk.
Right.
With the data that we're showing you.
Right. Yeah, and today's a good example, right? I mean, you could watch the show and look at the charts and say, okay, you know what? I'm in retirement. I don't want to. I'm worried that the market's going to fall here going into the election.
Go to G.
I'm going to G, right? Or you could say, you know what? I'm good. I think we lost about 4 or 5% since the top, in the last 2 weeks, and I'm getting back in 100% because I think we got support here at the moving average lines. I think my candidate's going to win and the market's going to go higher. Great. But whatever your risk tolerance is, like, do it, right? Yeah. But to answer your question, at the end of the day, you're going to have to really just do it. Right. I mean, now, to answer the very, very specific question, if you're watching the show and it's Sunday night, what should you do? I would wait. I would stay exactly where I am.
And that's just based on what we know right this second.
Yes.
Right? That wouldn't be, normally it would be, sync up as soon as you can.
The general answer is you're going to have to bite the bullet and sync up.
Sync up. Now, if you're listening to this Sunday night, just hold up for a second because we're at a point where that might not be the best. We don't know. Right.
It's getting close to the end of the month. Yeah. We don't know which way the market's going to go. I mean, but by the end of the month, you would want to be
definitely would want to sync up. Yeah. All right. Because we get that question a lot. And so, it's nice to kind of circle back to it. We've got at least one blog post, if not a couple, that, and it's called It Depends, because we get the question about how to sync up. But I think, it's important for our new members to kind of see where we're coming from on that.
Yeah. Yeah. I mean, anybody who has questions, email it in, Facebook, whatever, Twitter, keep asking because no one else is going to answer those questions.
Yeah, nobody. All right. Well, it was a good show this week. Yeah. If you guys just remember, we have our new site up at growmytsp.com, and new members go there. Share it with your friends. It's a great time to get a great value, and we'll see you next week.
All right. Have a good weekend.
There's the music.
All right. There we go.
I was sleeping on the job.
We got one job, Connor. One job.
Play the music, man.